Hi, I'm Steve LaFrance with a brief update. February was another active month with stocks trading lower and a late month sell-off as sentiment weakened. The S&P's recent decline erased most of its post-election gains, which had been driven by expectations for stronger growth and deregulation under the new administration. Smaller companies underperformed, with the Russell 2000 ending the month more than 10% below its late November peak. Beneath the surface, the January market rotation continued as last year's outperformers lagged. The Mag 7, which drove most of 2024's gains, and I only mention for discussion purposes, fell by 8% and dragged down the Nasdaq and the S&P. In contrast, defensive sectors and international stocks traded higher, while gold set a new all-time high. The decline in interest rates caused bonds to rise, with the U.S. bond aggregate delivering a 2.2% total return, partially offsetting the stock market sell-off. Corporate investment-grade bonds produced a 2.4% total return as Treasury yields declined, with the 10-year yield falling to its lowest level since early December. Now back to stocks. The sell-off wasn't triggered by a single event or data point, but by a combination of three interconnected factors. First, in the stock market, NVIDIA's highly anticipated earnings report failed to reignite enthusiasm for AI companies, leading to a broader sell-off in tech stocks. Second, economic reports underperformed expectations and revealed a cooling U.S. economy as the services sector contracted and consumer confidence deteriorated. The combination signaled slower consumer demand, a key pillar of economic growth during recent years. And third, in Washington, policy uncertainty remained high, with renewed tariff threats against key trading partners and DOGE spending cuts. Just this week, the White House applied new 25% tariffs to imports from Canada and Mexico, along with doubling China's tariffs to 20%, declaring that all three countries had failed to do enough to stem the flow of fentanyl and its precursor chemicals into the United States. The market's primary concern now, imposing tariffs and reducing government spending, could slow economic growth. Following the election, the market's expectations for tax cuts, deregulation, and energy production fueled hopes for stronger U.S. economic growth and drove the markets to new highs. Investors were very optimistic about a Goldilocks scenario of moderate growth, cooling inflation, and lower interest rates. The focus has now shifted from solid earnings growth and a robust labor market to concerns about slowing economic growth and uncertain government policy. We will keep a close eye on how our trade negotiations develop, but don't believe investors should make any dramatic changes to their portfolio strategies. That's all for now. Stay the course, take care of yourselves, and thank you for your trust and confidence.